All right, welcome back to the deep dive today. Where do we even begin? We're opening up a forensic file on a topic that is just, it's this incredible intersection of extreme wealth, government policy, and, well, pure geographic temptation.
It really is.
We are talking about Puerto Rico's Act 60.
And this isn't just some minor tax credit. I mean, this has been described, and I think for very good reason, as probably the single most powerful legal wealth preservation tool that's available to American citizens right now.
Right. The word legal is doing a lot of heavy lifting there.
It is. It's a strategy that operates completely out in the open,
Right.
but the commitment required, the compliance rules are so detailed, so labyrinthine, that all the hype you see online just misses the fine print.
And that's our mission today, isn't it? To conduct a really deep, necessary investigation. We've got to move past the glossy travel brochures and figure out the true cost of paradise.
Exactly. We need to decode Act 60,
Right.
clarify all the traps that can trigger what people call an audit from hell.
And then perform a kind of lifestyle audit.
Mm.
Is the financial prize, is it actually worth the personal and geographical chains it puts on you?
Well, you have to start with why it's so magnetic.
Mhm.
And it all comes down to this just astonishing financial contrast. So let's set up a scenario. Imagine you're a trader, you're living in New York City,
Okay.
you have a great year, you sell some Bitcoin, you realize a $10 million profit.
Life-changing money.
Absolutely. But then the tax bill comes. By the time you account for federal capital gains tax, New York state tax, and New York City tax,
Yeah.
you're looking at giving away about half of that, $5 million.
Gone. A brutal 50% hit. It just fundamentally changes your relationship with your own risk and your own work.
It does. Now imagine you execute that exact same $10 million trade,
Mhm.
but you do it while you're a bona fide resident of San Juan, Puerto Rico.
Okay.
The promise is, you keep the full $10 million.
Wait, the full 10 million.
The full $10 million. That means 0% federal tax and 0% Puerto Rican tax on those capital gains.
Moving from a 50% liability to zero,
Yeah.
that explains everything. That's why so much smart money is flowing there. But my first question, and I'm sure it's the listener's first question, is how is this legal? How is this not just some form of, illicit offshore tax evasion?
And that is the essential distinction. We have to hammer this home right at the top. This is not the Cayman Islands. It is not illicit.
Because Puerto Rico is a U.S. territory.
Exactly. It operates entirely within the U.S. federal system. It's under U.S. sovereignty.
Yeah.
That means U.S. citizens who move there, they quit their citizenship, they keep their passport, and they're operating under a legal framework that was intentionally created by the territory's own government to bring in capital.
So it's an incentive program.
It's a massive incentive program. And because of the unique tax relationship between the U.S. and its territories, the federal government agrees to exempt these citizens from federal tax on most of their Puerto Rico-sourced income. But, and this is the huge but,
Here it comes.
that 0% promise comes wrapped in rules so strict that if you fail to comply, you don't just lose the tax break. You attract an audit so invasive, you will wish you had just paid the 50% in New York.
Okay, let's unpack this. We've set the stage. We see this incredible geographic arbitrage. But we have to start with the foundation, the legal architecture. Because when you just hear 0% tax, that is a massive oversimplification.
It is. It suggests everyone gets the same deal, when in reality, it depends completely on where your income is actually coming from.
Right. So let's get into what Act 60 actually is.
Well, the first big misconception is that Act 60 is like one single tax law. It's not. It's really an umbrella law that was passed in 2019,
Yeah.
and it just consolidated a bunch of older incentives.
Okay.
And to really get it, you have to understand the two main pillars it was built on. There was the old Act 22, which was for investors, and the old Act 20, which was for businesses. You have to know which basket your money is flowing from.
So for the listener out there who is, a trader, or they're holding a massive crypto stack, or they have a big portfolio of stocks, the person whose entire financial world is about asset appreciation, they're looking at the investor law, the old Act 22 part.
That's the one.
So tell us about this. This is the holy grail part of Act 60.
It really is. The investor law provides a 0% tax rate on qualifying long-term capital gains. That is the magnet.
0%.
Zero. And this applies specifically to the profit you make from selling assets, things like stocks, gold, private equity, and so critically in today's world, cryptocurrencies.
So if you buy it and sell it for a profit,
If you bought that asset while you were a resident of Puerto Rico and held it long enough to qualify for long-term gains, that profit is exempt from both U.S. federal tax and Puerto Rican local tax.
The implication of that is it's profound. So
Hmm.
if I move to San Juan and then I invest, say, $10 million into some high-growth tech stock, and over 5 years it grows to $30 million.
That $20 million profit is entirely tax-free.
That's a generational wealth accelerator.
It is. I mean, provided you meet all the residency rules we're about to get into.
Mhm.
And it also extends that 0% benefit to dividends you might get from Puerto Rico-based companies.
Mm.
The whole policy is designed to lure capital onto the island using this incredible tax shield.
So that's the 0% piece of the puzzle. That's the hype.
That's the part that gets people to uproot their entire lives.
But now we have to draw that really crucial distinction. Because not everyone is just a passive investor. A lot of high net worth people are active entrepreneurs. They're consultants, software developers, SaaS founders. They need to run an active business from the island.
Right.
Their income falls into that second basket, the business law, the old Act 20.
That's right. And if you move your company's headquarters, your main business operations, to the island, you get huge incentives. But the tax rate is explicitly not zero.
Not zero.
The business law gives you a preferential corporate tax rate of 4%.
4%. Which, let's be clear. Compared to almost anywhere else in the world, this is still an incredible tax advantage.
It's a game changer. The U.S. federal corporate tax rate is 21%.
And that's before state taxes.
Exactly. When you add state taxes on top of that, you're often getting close to 30%.
Oh.
So moving from, say, a 30% tax rate to a flat 4% rate in Puerto Rico, that's transformative for a company. It allows massive reinvestment. But you have to internalize that distinction.
0% for your passive capital gains.
And 4% for your active business income.
And that 4% rate, it's not for just any business, right? You mentioned it has to be an export service. What does that actually mean?
So the goal of the law is to import capital, not to compete with local businesses. So the rule is that your business have to provide an export service.
Meaning your clients are off the island.
Right. At least 80% of your revenue has to come from customers or clients who are outside of Puerto Rico. So think about some specific examples that would qualify.
Like a sauce company.
A perfect example. A cloud-based software company in San Juan that sells subscriptions to users in, say, Europe, Asia, and the mainland U.S. That works. Or a remote advertising agency whose entire client base is in New York and L.A.
A consultant who flies around the world but bills from their PR office?
As long as they're billing non-PR clients, yes.
Yeah.
But if you move there and open a local bakery or a law firm that serves local people, you're paying the standard, much higher local income tax rates. The benefit is gone.
That clarity is so important. Okay, now let's drill down into what seems like the single most common trap for new residents, especially in the crypto space.
Yes.
The crypto kicker, the difference between price appreciation and passive yield.
This requires just forensic level precision in how you categorize your taxes.
Yeah.
Act 60 gives you that 0% on capital gains, the profit you make when you sell. But decentralized finance, it's created these massive passive income streams that don't involve selling at all.
You're talking about things like staking, crypto lending, liquidity mining.
Exactly. And this is the trapdoor. The IRS views the income you get from staking or lending not as a capital gain. They see it as ordinary income.
Like getting a paycheck.
It's treated exactly like earning a salary. When your crypto mints new coins or you earn interest on it, that yield is just its income.
And since you're earning that income while you're a resident of Puerto Rico, it's subject to Puerto Rico's regular income tax rates, not the 0% Act 60 rate.
Precisely. So if a beneficiary moves to the island and then earns, say, $1 million in staking yield over the course of a year,
They're not paying zero on that.
they're paying Puerto Rico's highest marginal income tax rate on that $1 million, which can climb all the way up to 33%.
33%. That is a shocking number for someone who moved for the 0% crypto tax headline they saw online.
It is.
So if you're a big-time staker, your main source of income is getting taxed at a third, and Act 60 doesn't help you at all.
It completely derails the entire financial plan. So the key takeaway, what's fascinating here is the 0% magic only applies to price appreciation, selling an asset for more than you paid. If your strategy is all about generating yield, you either have to plan for that huge tax bill or completely change your strategy before you move.
That distinction, The idea that the law follows the history of the asset, not just where you are when you earn the income, is a perfect segue. It leads us right into the biggest structural hurdle of them all. The
Yes.
mechanism that's designed to stop people from just, washing away their entire financial past.
This gets to the heart of it. This is the number one reason wealthy people can't just pack up their stocks and move to avoid taxes. You cannot retroactively erase the tax liability you built up before you became a resident.
Okay, let's round this. Let's use a clear scenario. We have the trader. 10 years ago, while living in California, he bought a huge chunk of some stock, or maybe Bitcoin, for $100. Today, he's packing his bags for San Juan, and that asset is now worth $100,000. So he's sitting on this massive, unrealized gain that was built up entirely while he was a California resident.
And the common but very dangerous assumption is this. Okay, I move today, I get my residency set up, and tomorrow I sell everything. Act 60 gives me 0% on capital gains, so I pay nothing on that whole $99,900 profit.
But the reality, based on the IRS and Puerto Rican tax rules working together, is a firm, loud no.
A completely unambiguous no, you do not pay 0% tax on those historical gains.
Why not?
Because of something called the split year rule. The IRS applies this precise chronological split to your capital gain based on your residency. You can't erase the tax liability that accumulated while you were a full U.S. resident on the mainland.
So the tax isn't just about where you are when you click the sell button. It's about where you were while the asset was actually gaining value.
That's it exactly. Let's walk through how they calculate it. The gain that accrued while you were a U.S. resident. So, from your initial purchase price up to the fair market value on the day you officially became a bona fide Puerto Rico resident, that portion is considered U.S. source income.
And it's taxable by the IRS.
It remains taxable by the IRS no matter when you sell it.
That's a fundamental constraint. It really proves that Act 60 is an accelerator for future success, not some kind of magic eraser for your past success.
That is the crucial realization everyone needs to have. It's only the growth, the appreciation that happens after you officially establish residency. Only that future growth is captured by the 0% tax shield.
Okay, here's where it gets really interesting. Let's do the math with our example to show the listener how serious this is. The trader bought his asset at $100. He moves on January 1st, 2024, and on that day, the asset is worth $100,000.
Okay, so that $100,000 value becomes his new baseline for U.S. tax purposes.
Right. Now, let's say he waits. He lives in Puerto Rico for 2 years, and on January 1st, 2026, he finally sells the asset for $250,000.
So his total profit from the very beginning is $249,900.
How does the IRS split that up for taxes?
Okay, so the first $99,900 of that profit, the growth from $100 to $100,000, that all happened before his move.
So that's subject to U.S. federal capital gains tax.
Correct. He owes the IRS tax on that piece. But the remaining $150,000 of profit, the growth from $100,000 to $250,000, that all happened after he became a Puerto Rico resident.
And that's the tax-free part.
That $150,000 chunk is entirely tax-free under Act 60.
So even after this massive life change, setting up residency, jumping through all the hoops to claim 0% status, he is still writing a very large check to the IRS for the gains that happened while he was living in California.
He is. And it requires meticulous record keeping. I mean,
Right.
You need undeniable proof, dated to the hour, of that asset's fair market value on the exact day your residency status changed.
Because if you can't prove it,
If you don't have that forensic precision, the IRS can contest your baseline valuation and try to tax the entire gain. It just reinforces that Act 60 is strictly for future growth.
this split-year rule completely changes the strategy of when you should move. It's not about what you've already made. It's a bet on what you're going to make.
It demands market timing. You have to move before the asset makes its big, explosive, parabolic move. If you move after it's already skyrocketed, you've missed out on the biggest tax benefit. The trader is left with this really terrible strategic
There's
choice.
two options, right?
Two options. Option A, he holds the asset after moving and just gambles that it's going to appreciate a lot more, enough to make the move worthwhile despite the tax he'll eventually owe on the past gains.
Or option B,
Option B, he sells everything before he moves. He bites the bullet, pays the full U.S. capital gains tax on all his profit up to that point, and then moves to Puerto Rico with a net cash and starts over, reinvesting in new assets.
and if he does option B by selling and reinvesting, that resets his cost basis. It ensures that 100% of all future growth is captured by the 0% tax shield.
It's the only way to do that. but it means writing a very, very large, immediate check to the IRS before you even start. So the split-year rule, it really shuts down the whole strategy for anyone whose main assets have already peaked.
Which means this whole thing hinges not just on your financial paperwork, but on proving your physical, real-world life commitment.
Which brings us to the core non-financial friction point. I mean, the entire perfectly planned financial structure it completely collapses if you fail what they call the presence test.
This is the lifestyle trade-off.
It's an absolute non-negotiable restriction on your personal freedom.
You're trading millions in potential tax savings for this ironclad commitment to be in one specific place. The rule is you have to be physically present in Puerto Rico for a minimum of 183 days per year.
Half your life. Half your life has to be spent on that island. And it's not a suggestion. It's not a flexible goal. If you fail the 183-day test by a single day, you lose all your Act 60 benefits for that entire tax year.
So you retroactively become a U.S. taxpayer for all those games.
Yes, and you attract massive penalties, and you open yourself up for that catastrophic audit we talked about. It demands constant obsessive tracking of your location.
And given what's at stake, the IRS isn't just going to take your word for it. They don't just ask for a little diary of your days. They launch a full-on lifestyle audit.
They do.
So what are they looking for? What are the specific things they investigate to prove you're not really committed?
They do not trust simple day counts. They're looking for irrefutable proof that Puerto Rico is the true center of your life, and the level of detail is just astonishing.
Give me some examples.
Okay, first, your home. They look for the sale of your mainland U.S. home. If you keep a mansion in Miami, that is a huge red flag. They want to see your utility bills in Puerto Rico, gas, electricity, water, and they want to see patterns of usage that look like a family actually living there, not just visiting on weekends.
So they're looking for signs of life.
Exactly. Then, financial ties. They want to see local Puerto Rican bank accounts with regular activity. Are you buying groceries there? Gas? Eating at local restaurants? They track your credit card swipes to see if your spending patterns show a center of life somewhere else.
And what about family?
This is huge. Where are your kids enrolled in school? Is your spouse's main social life or work based in Puerto Rico? They'll look for local gym memberships, proof you're using local doctors and dentists.
They even check for things like a local driver's license.
Oh, yeah. Local driver's license, vehicle registrations. Have you terminated your old U.S. state voter registration? Every single point of connection you have to the mainland has to be demonstrably severed and moved.
It's a complete dismantling of your old life. You can't just be a jet setter who has a condo there.
And technology is the auditor's absolute best friend here. We have to talk about how they track you, specifically with your cell phone.
Because your phone is the ultimate tether. It proves where you are.
It's chronological and it's indisputable. Your phone is constantly pinging the nearest cell tower, and that metadata gets recorded. The IRS can, and they absolutely do, get court orders to access that data from the major carriers.
So if the trader claims he was in San Juan for 183 days, but his phone was pinging towers in Aspen, Colorado for 190 days.
The case is over. It's done. That data is an unassailable record of noncompliance. Your Act 60 status is revoked, penalties start, and the audit from hell begins.
The irony is just, it's so rich. You get maximum financial freedom, but you have to surrender maximum personal freedom of movement.
You're trading millions for a physical tether, and that tether is reinforced by other mandatory commitments. The first one is the primary residence requirement.
You can't just rent a small apartment to have an address. You have to buy.
Exactly. The law mandates that you have to purchase a primary residence on the island within 2 years of moving. This forces you to inject real capital into the local real estate market, to set down a physical anchor, and to deal with all the friction of owning a home there.
And there's another financial commitment too, right? A charitable one.
Yes, there's a mandatory annual donation of $10,000 that has to be made to certified local nonprofits. It's basically a non-negotiable fee for the tax break, designed to counter the idea that these beneficiaries are just extracting wealth.
This really is the definition of trapped in paradise. The mandatory presence is the chief lifestyle trade-off, and it's a heavy one. This raises an important question. What are the practical realities of being locked into that paradise?
Well, now we have to move beyond just the financial and legal ledger. We have to look at the geopolitical, the social, the infrastructural friction points. Because when this much wealth moves this aggressively into one place, it creates tension. And tension translates directly into risk.
We've all seen the reports about the growing resentment from the local population. These Act 60 beneficiaries are sometimes called, and not kindly, Act 60 colonizers.
Right. And they're seen as driving up prices, displacing locals, and changing the culture. This political context is a major form of regulatory risk.
Because the same government that created the incentive can take it away.
Absolutely. The influx of wealthy Americans has definitely driven up demand for high-end real estate, especially in places like San Juan and Dorado. That pushes housing costs out of reach for many long-term residents, and that creates a deep social friction that eventually shows up at the ballot box.
So while Act 60 is the law today, if public pressure continues to build, it could be amended, restricted, or maybe even terminated one day.
That is the long-term bet you're making. You're moving your family and your entire financial future based on the political stability of a very controversial policy. And then on top of that, there are the everyday practical realities.
The infrastructure. Life on an island that is still recovering from major hurricanes where things we take for granted aren't always reliable.
The infrastructure fragility is probably the single biggest daily non-financial cost. The island's power grid is notoriously fragile. Power outages are common.
And not just for a few minutes.
No, we're talking hours, something days. For an entrepreneur running a high-stakes global business or a trader who needs constant connectivity, it's unacceptable friction.
So you have to account for that. You basically have to build your own private, redundant infrastructure.
Precisely. You cannot rely on the standard grid. You can't rely on a single internet provider. So that means you're making a heavy investment in things like industrial-grade backup generators.
Not just a little one from the hardware store.
No, something that can power a large home, an office, air conditioning for days on end. You need battery backup systems to bridge the gap, and you need redundant internet, maybe a fiber line, a cable line, and a satellite hookup to make sure you're always online.
And the cost and the headache of maintaining all of that. The fuel for the generator, the maintenance contracts, that eats away at the pure tax savings.
It absolutely does. You're trading your tax dollars for the hassle of maintaining your own operational reliability. It's a huge sacrifice of convenience.
Now, let's talk about the ultimate threat, the thing that shows the U.S. government never really lets go of its citizens, the exit tax monster.
Right. We have to be very clear. Moving to Puerto Rico does not trigger the exit tax.
Because you're still a U.S. citizen. This is why it's called the golden cage.
It is the golden cage.
Yeah.
It lets an American get to near total tax neutrality on their future gains while, crucially, keeping their U.S. passport and all the global mobility that comes with it. That is a unique position in the world.
Now, what if later on that individual decides they want total global tax freedom? They want to renounce their U.S. citizenship for, say, a Maltese passport.
That's the moment the final trap springs. If that person is considered a covered expatriate, which basically means they have a net worth over $2 million or have had a high income tax bill over the last 5 years, the U.S. government asserts its final claim.
If we connect this to the bigger picture, this is where the IRS gets its last massive bite of the apple.
The exit tax is triggered. And the IRS basically treats the day you renounce your citizenship as if you sold every single thing you own worldwide the day before you left.
Wow.
They calculate the capital gains tax you would owe on all those deemed sales, and you have to pay that massive one-time tax bill before you're officially allowed to surrender your passport. And this even applies to assets that grew tax-free while you were under Act 60.
So the U.S. tax system maintains permanent leverage. Act 60 is a fantastic long-term strategy for building wealth inside the U.S. system, but it is not a permanent escape hatch from it.
It's a strategic delay. It's not an exit ramp.
Okay, so we've uncovered the traps, the split-year rule, the 183-day physical prison enforced by cell phone data, the political risk, the shaky infrastructure. Now we have to synthesize all of this. We have to answer the final critical question for the listener. Is it actually worth it?
The conclusion from our investigation has to be that Act 60 works, but it only works if you are willing to do a total life reset. It demands absolute full commitment.
It's not just a tax strategy you file once a year. It's a new identity.
So we need a playbook for success.
Mm-hmm.
Rule number 1, based on all this forensic data, do the math and do it precisely. The savings have to dramatically outweigh all of these friction costs.
And what are the biggest costs that people might not think about?
Well, there's the high cost of the specialized lawyers and accountants you'll need. There's the mandatory purchase of a home. There are potentially much higher costs for private schools if you have a family. And then there's the big one, the cost of buying and maintaining all that redundant infrastructure we talked about.
So there's a threshold where it starts to make sense.
There is. The sources we looked at suggest you need at least $250,000, maybe even $500,000 in annual capital gains profits you're realizing every single year for the savings to really justify this massive upheaval.
Okay, rule number 2. This flows directly from that split-year trap we discussed. Move early.
Your financial returns are only maximized if you move before the asset explodes. If you wait until after the big parabolic move, you're mostly just benefiting the IRS when you finally sell. You have to relocate when your assets still have most of their growth ahead of them.
And finally, rule number 3. Commit fully. This is all about intent.
The IRS audit is looking for intent. So that means you need to do a complete severing of your old ties. Sell the U.S. home, move your important belongings, enroll your kids in local schools, shift your financial center of gravity, and make sure those cell phone pings are consistently, demonstrably in Puerto Rico.
Because anything less is just waving a giant red flag at an auditor.
Exactly.
So what does this all mean? The final verdict. Is it worth moving your entire family, your entire life, to an island to save millions of dollars?
It comes down entirely to your personal lifestyle and your tolerance for risk and friction. The financial upside is unparalleled for an American who wants to keep their citizenship. But the restrictions, they're absolute. You are trading money for your freedom of movement.
So if you're, say, a single crypto trader or a remote tech founder who lives their life online anyway, and your assets are about to go parabolic and you can handle the heat and the paperwork, it might be the single greatest financial decision you ever make.
The contract is worth signing for that person. But if you're a high net worth individual who needs seamless, predictable infrastructure, or your business requires constant, spontaneous international travel, Act 60 is a golden cage that will very quickly turn into a financial disaster when you inevitably fail that 183-day test.
So the final conclusion. The financial incentive is real and it's massive, but the commitment required is absolute. It is not a strategy for the faint of heart.
No, or for the poorly organized. What's fascinating here is that Act 60 works, but it only works for a very specific type of person whose lifestyle can perfectly align with that rigid commitment and who, crucially, moved before their assets peaked. For that smart money, geography really is an asset class. But it's an asset class that demands total devotion.
The future belongs to the owners. And this whole deep dive really shows how closely the U.S. system tracks who owns what and, more importantly, where they are. So this brings us to the provocative thought for you, the listener, to take away from our investigation.
Okay.
If you had to choose between maximum financial freedom, that beautiful 0% tax rate, and maximum personal freedom, the absolute ability to travel and live anywhere you want with no geographic restrictions, which one would you sacrifice? Think about what kind of owner you truly want to be.
That sacrifice. That defines the true price of paradise.
We'll see you on the next deep dive.